We're here to talk about Silicon Valley real estate market conditions on the week ending July 11th, presented on Saturday morning, July the 12th. These are the key chapters we're going to go over. The timestamps are in the YouTube description below, along with the associated graphics. Here's a summary of my micromarket data. Basically, the blue indicates we're much cooler, favoring the buyer than we typically are for this time of the year. And then the data over here is the actual current data. So even though it's favoring the buyer, it's still a fairly balanced marketplace. In other words, even though it's taking longer to sell than it typically does, it's still selling fairly quickly. Here is one of my key concerns is the sales volume. You can see that sales volume has been down now for the last 18 months and actually quite a bit longer than that if we had more data. What I found particularly interesting is the Mercury News is now reporting on closings in the month of May, which are sales in the month of April, more or less, which they're saying are down, and they're blaming that on the tariff. Well, that's exactly why I developed this slide, was to show the impact on the tariffs, which I was expecting to be there. And this is basically April 1st, this vertical line here. And you can see the distance away from the blue line is unchanged basically for the last 18 months. So there's really been no change in the volume of sales. Sales are down from where they're supposed to be at this time of the year. They're supposed to be up here on the gray line, but there was no significant change anytime in the last couple months. And that's one of the advantages of this presentation is you're getting data from today back 5 weeks. You're not getting data back from the month of April. Here's a summary slide of the key indicators. We start off with inventory. The concept is the same for all of them. The gray line is the typical based on the previous 10 years, the median for the previous 10 years for the same week. The red is the hottest you'd expect it to be based on the 10 or 90 percentile for inventory. It's low inventory, so it's the 10 percentile level for the past 10 years. Blue is a buyer's marketplace, ice cold buyer's marketplace, and that would be the 90% inventory. You can see we were right around the 90% of inventory until 2 weeks ago, and then we had a huge drop, and then we basically are starting to follow the normal pattern again. It is unique that this drop in inventory happened in Silicon Valley, which is Santa Clara, Alameda, and San Mateo counties, as well as the cities, which is San Francisco and Marin, but it didn't happen in the other areas. So putting numbers on it, we have 3,000 listings roughly. That's 7% more than we typically do. Our typical number is 2,800. The most we would have is 3,400. Moving down to offers accepted, you can see that the concept's the same. Offers accepted have been basically following the blue line for some period of time now. The center of the graph is this current week, and you go back 13 weeks, which is 1 quarter. You have the trend lines going forward for the next 13 weeks or quarter, and that's just to show you the direction you'd expect the data to go. So we're selling 2,062 listings where you normally sell 2,600. So we're missing roughly 600 transactions. So we're only selling 77% of the offers that we normally do. Transactions are actually closings. It's very much a lagging indicator. The fact that it's a little bit below the blue line and the offers accepted has been at or above the blue line would actually tend to suggest that the transaction failure rate is slightly higher than it normally is. Because if your offers have been on the blue line for a significant period of time, and basically 6 weeks now is that significant period of time because most escrows close by 6 weeks, you'd expect to be at the blue line and you're below. And again, that suggests a little higher the transaction fail rate. But the numbers are basically unchanged. We went 13 weeks ago, we were at 2,020 listings. Now we're at 2,100. So yes, you're going up 100, but what's that really mean? Well, on a percentage basis, you were at 89% of the transactions just a quarter ago, and now you're only at 75%. So that fairly flat level of transactions that actually went up by 5% compared to what the normal increase is, you've lost 15% of the marketplace. And we have been hovering around 75% of the offers accepted and closings now for quite a bit of time. Days unsold inventory is the seller-buyer balance. That's the supply-demand balance. And that's the turnover rate. How quickly is the market turning over? Now, I talk about days because we're talking about a relatively few number of days, 45 days and 51 days. Typically, our quickest is 27 days. Our typical is 37. Our slowest is 47. So when you're talking about numbers of that magnitude, talking about it in terms of months like most of the country does is pretty absurd, in my opinion. You're talking about fractions of a month. Most of the country considers 3 to 7 months to be a normal marketplace. I consider somewhere between 6 and 11 weeks to be a normal marketplace. So weeks would have been a better thing. I may change, but I've been in the habit of calling it days unsold inventory since I invented it back in '97, I guess it was. And I'm sticking with it for the time being, but weeks probably makes a little bit more sense. You were at 62% slower than you normally were, 162% of the time that it normally takes a quarter ago. Now you've actually improved. So now you're at 138%. So you're faster compared to normal, but you're slower in raw counts. You're now at 51 days, which is a pretty high number, which is why you're above the blue line, up from 45. So you've gone up almost a full week, but you've actually had an improvement because the market normally slows at this time of the year. Talking about marketing time, that's our next indicator, days on marketplace. There's two common metrics that are used, average and median, and I dislike both of them, and we'll talk about that coming up on another slide. I use the 75th percentile. It shows what's happening to the long typical seller, and the data moves more. A quarter ago, we were at 18 days, 16% longer than normal. Now we've almost doubled at 34 days, and that's 84% longer than normal. And you can see that increase because you're now significantly above the blue line. So even though it may be quick to sell 3/4 of your inventory in a month, and in my opinion, that is quick, that is much slower than Silicon Valley normally is at this time of the year. Price reductions. This is sort of a measure of the seller's expectations to the market reality. So typically as the market slows, especially when the market just starts to slow and people aren't expecting it to slow, that's when the most price adjustments happen because sellers are looking at the rearview mirror, expecting prices to be up, and they're not. So you can see that we are at or below the blue line. So we're taking more price reductions than we typically do for this time of the year. And it's actually fairly significant. We were taking 3.5 times larger price reductions a quarter ago, but keep in mind, that's only 0.75%. So that says that a quarter ago, the normal amount of a seller discount is 0.25%. And that's because the vast majority of the sellers do their homework before they put their house on the marketplace, and they price their home to sell. And they sell quickly and they sell without doing a price reduction. Fast forward to present time, you're now at 152%, so 1.5% of a price reduction. So your price reduction in magnitude has doubled, but yet your compared to normal has been cut in half compared to where it was 13 weeks ago. So that shows you how dramatically the market normally changes at this time of the year. In other words, you've had a significant improvement on the percentage of reduction if you were comparing it to normal, yet that reduction has doubled. So you've had a halving compared to normal and a doubling on raw count. Overbidding is a lagging indicator, and this I'm just comparing raw numbers. A quarter ago, you normally have almost a 7% price overbid. A quarter ago, we were at 8.3%. So we were actually overbidding 1.4% more than you typically do. And that's why we're above the gray line. Your purple line's here, your gray line's down here. Now, fast forward just 1 quarter, 13 weeks, the normal overbid is now 7.1%, so more or less unchanged, but we're only overbidding 4.3%. So your overbidding has been cut almost in half at a time when it's normally flat. And also keep in mind, this is where the market was basically 3, 4, 5, 6 weeks ago, because we need the closings to determine what the sold price was. Now we're looking at the indicators over a long period of time. Inventory is this purple line, and notice the huge drop last week, and the trend has been down fairly significantly. We went from 38% more inventory than you'd expect down here into only 7% more inventory than you'd expect, with a fairly significant drop going into 4th of July. Coming out of 4th of July, there was no rebound. It's basically flat here in Silicon Valley, which again is the 3 counties. Moving on to offers accepted. Offers accepted have been basically hovering around this 75, 77% mark for a fairly long period of time. In fact, we can get an idea. It first hit that mark back here in July of 2022. So we've been there for 3 full years. Yeah, we did a few oscillations coming into it. And, if you want to argue, and we've only been in there probably more realistically since July of 2023, I'm not going to argue with that. But, it's still been at this low level for some period of time. You can see the run up after the pandemic where we were selling more than normal. You can see the huge impact and the number of offers based on the pandemic when we weren't even able to show properties. And then the third line, the gray line, is the days unsold inventory. So this is the supply demand balance. And you can see that we're taking 38% longer than we typically do to turn over the marketplace. you can see we were slower and in record high territory. And that wasn't very long ago. It was within the past 13 weeks. We were 72% longer than we typically are. So again, in rough numbers, we're half more, we're now at 38% instead of 72%. That's roughly cutting in half of that longer marketing, not marketing time, but turnover time. Now we're looking at each component individually. This is your inventory. So you can see that significant drop that we saw going into July the 4th. And now we come out of July the 4th and you can see a little rebound. So you have between typical and surplus inventory, but you've had this huge improvement, which again was limited to Silicon Valley as well as the cities and not so much the other three regions that I follow. This is on a percentage basis. So you can see we were at, what would that be, 35% slower than normal. And now we're down here and we're somewhere around 7% slower than normal. So a fairly significant improvement in the marketplace. Here's now looking at the number of offers. You can see we've been hugging that blue line more or less. We did a little bit of improvement here. In fact, if you want to argue, you could say we were doing better around April the 1st versus less than April the 1st. But, it was a short-lived period of time, and now we're right back on top of the blue line. So for the most part, I would say we're more or less following the blue line. And again, you could come back and say you first hit that blue line in about July 1st of 2022, because you're clearly early in 2022, we were way up at the top. So you can't go past July 1st of 2022. Here's on a percentage basis. Again, you can see how we've been right at that 75, 78% mark that I've been talking about for a significant period of time. So we've lost 25% of the marketplace. Here's basically your turnover rate, your supply demand balance. And you can see that you had this huge improvement going into 4th of July, triggered mostly by a drop in inventory, which was one of the steepest drops I saw. And I went back and looked at it, and I can't find a drop that steep that quickly. And I don't know what triggered it. My best speculation, and I don't feel real comfortable with it, so it's a pretty weak speculation, is that a lot of agents were using July 1st as an expiration date on their listings. And because the market slowed on them, the listings actually expired. Because we had a drop in offers and we didn't have an increase in the number of offers, we had a drop in inventory, which means they had to go somewhere. And the only other place they can do is withdraw on expired listings. And, I don't follow those because they're really usually not relevant, but I think that's probably what happened. I don't have any other explanation, because to have a drop in the level of inventory available, you'd have to have an increase of sales or some other drain on the supply. And if you didn't have an increase in offers, the only other drain on supply is expirations and cancellations and withdrawals. So anyway, we still have, and the return of the DUI, which is almost back to where it was now, is because we had low offers. This weekend, I expect with more inventory again, without the holiday, I expect offers to rebound. So I expect this DUI to come down and improve again next week. Here's looking on the compared to normal over the long period of time. You can see that we got over the 170% of normal. And you can see how short-lived that was. Basically, all of the second quarter did a run up and a run down. It started right here on April the 1st, zoop, zoop. We're almost back down to where we were on April the 1st. It's almost like we did a gradual improvement or a gradual worsening. Here's marketing time, and I like the 75th percentile. The gray line's where it typically is. So that would be your median of the 75th percentile. You can see we had a few time shifts. The gray line is your typical line. So normally you peak out right here halfway through first quarter. We did that right at the end of fourth quarter. And then we improved dramatically. And then we started slowing. And we started slowing halfway through first quarter, where normally you start slowing halfway through second quarter. And so then we came up sort of like the gray line, but we started earlier than the gray line normally increases. So if you look at this, it is steeper, and it looks like it's going to continue to get steeper, where the gray line's a little shallower, but there looks like there's a time shift more than anything. And I don't have any explanation for why that time shift is. And there's basically no other time in the last 10 and a half years, so that, as you can see on this graph, where you've had that type of a time shift. So here's your marketing time. This is where we're still getting some pretty high records. We're now at a record high. So it's taking longer for sellers, for the 3 out of 4 sellers to sell. That time frame is longer than it has been compared to when you compare the same week to the same week. So I believe there's strong seasonal and cycles to the real estate marketplace, which is why I compare the same week to the same week. So it's now taking 84% longer than it typically does. So that's almost doubling. So if it took 12 days, instead of taking 12 days, it's going to take 21 days in rough numbers to sell the inventory. And again, that's not the complete inventory like Days Unsold Inventory, but this is the 3 out of 4 sellers to sell in that time frame. But that time frame is still relatively quick, so keep that in mind. Here is the sellers that are taking the largest price reductions. You can see we were taking sort of between the normal, the gray line and the blue line, so between the normal and the most price reductions. Then we had an improvement for the first part of first quarter, and then we had this second half of first quarter, we had this reduction, and we've been taking more price reductions than we typically do. Right now, we're caught up to the blue line, but that's more the blue line catching up to us. You can see how quickly the blue line dropped off. I think we're going to stay at or below the blue line, but there's no way to know for sure. Time will tell. Here's on a percentage basis. So now this is looking at the seller that's taking the 90th percent seller. Only 10% of the sellers are taking larger price reductions. How do they compare to normal? They're basically 32% larger than normal. We don't know what that normal number is, but this is just comparing, because if you were normal, you'd be down here on the 100% line. That would be exactly normal. So you can see basically since this was the peak of the marketplace, which I maintain happened right around Valentine's Day of 2022, you started having a huge increase. And basically once you got to July 1st, which is up here, we've been basically at more price reductions than typical. Here's the seller's average price reduction. So I do this just to show people that I'm not playing numbers by doing the 10 percentile. You know, like anytime I do anything weird like the 75th percentile, I try to balance that by introducing the normal metrics as well. And you can see it says the same sort of pattern. I still like the 90 percentile better, but you can see that we've been taking price reductions, the magnitude and the frequency of the price reductions increased. Well, here we just know the magnitude. The average magnitude increased earlier than it normally does, because it normally doesn't start increasing until halfway through second quarter. Again, it started to increase halfway through first quarter. Down on here, these are the percent off ask price. So large negative numbers is a larger price reduction. So right now, sellers on average are only taking about a 1.5% price reduction. So fairly small, but again, that's because the vast majority, more than 3/4 of the sellers aren't doing any price adjustment at all. Here's that average price reduction versus typical. You can see we were taking quite a bit more. We're now coming back up where we're almost back in the level where we've been for a fairly lengthy period of time, but it's still on the blue side of what you consider the line. You know, the line might be up somewhere like up here, so you're still below that, but you know, it's not outrageous. We're not back here like we were in 2022. We weren't back here where we were in the pandemic, and we're not even where we were at the end of first quarter, beginning of second quarter. Here's the frequency of price reductions. So this is how common, and we're now at basically 22.5% of the sellers are taking price reductions. So that's between 1 out of 4 and 1 out of 5 sellers are taking price reductions. So the vast majority of the sellers still are not taking price reductions. But you can see even in the slowest marketplace, we're only at a third. So the fact that you're at 22% and the most you get to is a third is fairly significant and more than normal. You know, again, normal is a vertical straight down line. So you're down here somewhere around 14%, and now you're up at something like 22.5%. So you're 50% more sellers are doing price reductions. Here's compared to normal again. So you're 60%. So there's the actual number, 60%. So that's a little bit off in my estimates. And on this basis, it's almost a record high. Yes, there was periods of time, the ones I mentioned, the pandemic and the 2022 slowdown, where we were taking even larger price reductions, but the level is higher than you would expect. Not only magnitude, you know, you'd expect it down here, but also how common is it to be up here? The periods of time when it's been at this level have been fairly short period of time, because this graph is showing you 10.5 years, and you have maybe a year here and maybe a half a year here. So maybe a year and a half out of 10.5 years. Here's the magnitude of overbidding. You can see we had aggressive overbidding just in the first quarter. We were above the gray line, but that abruptly changed on April 1st, and we've come angled down. And we're now taking quite a bit less overbidding than we normally do. We're not quite at the blue line, but we're getting close to the blue line. And here's showing the magnitude, and these are in just raw amounts. So right now, we're about 3% less overbidding than normal. So if the normal overbidding, I think, was 7%, we're currently at about 4%. And you can see that just A quarter ago, halfway through first quarter, we were 4% above what the typical overbidding was. So back here, the typical overbidding may have been 3%, and we were getting 7% overbids. So that's a pretty dramatic drop. That's a drop of 7% in the magnitude of overbidding. And for a seller to lose 7% on $1 million home is $70,000, and that's just in the overbidding. Here's the frequency of overbidding. You can see it's coming down. We're below 60%. If I read that quickly, it's probably 58% of the sellers are getting overbid, but we're now less than 3 out of 5 sellers are getting more than their asking price. And for most areas in the country, that would still be a fairly aggressive marketplace, but not here in Silicon Valley. Here's on a percentage basis. So we're getting 80% of the overbidding that you typically would. If you were typical, you'd be up here. You can see in first quarter, we were getting more overbidding, somewhere between 5 and 15% more overbidding than you expect. Now we're getting 20% less overbidding. And again, when you go back and look at it, there's very few periods of time, not only in duration, but in frequency, where we were getting this kind of less overbidding, less frequent overbidding. Here's my pricing models. I did update it. So we have 2 pricing models now. One showing you had an 11.4% price appreciation over the last 10.5 years. The other one, which I think is a little bit more realistic, is you had about 7.5 years at 12.1% price appreciation, and then we went flat. And yes, you are higher than the flat line is right now, but you can see we were higher last year, then we came back down. I would expect we're going to come back down this year. This is just an example, and this is median price, and we'll get into an explanation later in the presentation on how misleading that can be. Here's the first out of 3 distributions. This is on days on marketplace. What we're doing now is the purple line is the current week. Where we were a year ago is down here on the dotted line. So the market is taking much longer to sell. And here you can start seeing why I dislike the median. There's very little change in the median. You come up here on the 75th percentile, and there's a fairly significant change. This allows you to see all the changes. We'll step through, and now we're going a week at a time. So this is the direction where you'd expect it to go. So you'd expect this purple line to slow down a little bit, but then basically stabilize. So we could be close to the longest days on market. Then you accelerate quickly right around Thanksgiving. There's the peak, the slowest of the marketplace right around New Year's. Then you rapidly improve. There's the hottest we were basically sometime around March 1st to February 14th to March 1st. Now you're slowing down fairly significantly. But notice how the lines now are going to start slowing down in their magnitude. Like that wasn't much. That was a jump. I expect a little bit more slowing and then basically hit the plateau that we had last year. Anything does and can happen. So there's not a guarantee that it's going to just go up a little bit more. Right now, you can see that there's not many lines. It's actually closer to 30 lines on here. There's only 4 lines that I'm picking up that are slower than the purple line. So what that's saying is this year is quite a bit slower, longer marketing times than last year. Here now is the sellers that are taking the largest price reduction. This is the sellers that are taking from 2.5%. So I'm ignoring the sellers that are taking those huge price adjustments, which could be typos, down to only 17.5%. And the reason I do that is typically by the time you get to 17.5%, you have no price reduction. So most of this numbers past there is just adding in zeros. You can see now on the purple line, here quite a bit past the 17.5%. In fact, I think the number was 22.5%. So, here it would be useful to have more numbers, but that's just because we're taking larger and more frequent price reductions. So anyway, we'll step through and watch this. Now you're bouncing around and really not changing much. So that's what you'd expect the purple line to do, is not really change much. When do we expect this to change? This is probably going to change shortly after Halloween, be right before Thanksgiving. Right there, it's really starting to slow down, and now you're rapidly improving. That's the peak for the year right there, those 2 lines. And now you're slowing down, and not slowing down, but taking more price reductions. And now what is noteworthy, not only is the vertical separation here, which shows you the dramatic change, but the current price reductions is the largest and most frequent price reduction because, you're both horizontally and vertically lower on this graph than you've been any time in the past 52 weeks. So the sellers right now, in sort of a good time of the year to be selling, are taking more price reductions than they did last Christmas. And if that isn't sort of jarring, I don't know what is. Now, this is overbidding, the same concept, and this, you'll see the same thing. A year ago, you were up here, which is one of the highest lines on this graph. So this is about the time of the year when overbidding is just past its peak. And yet now the purple line is basically, arguably, the lowest line. Now, yes, this dotted line here is a little bit lower here, and there's a 3 lines lower over here on the 95% mark. But generally speaking, the purple line is the worst line. So a year ago, we were having one of the best overbidding lines, and now we're having one of the worst overbid, or I would call it the worst in the last 52 weeks. So you can see the bouncing around, a little bit cooling off from last year. Now, right now is we're probably a solid bouncing, really no change for several months in the summer. And now it's going to be closer to Christmas before you start dropping down because of the lag time from closings. There was the slowest, which would look like it was February 7th, something like that. That was the peak on April the 12th. And now you're slowing down. And by slowing down, you're getting less and less overbidding. And now right there is the current, which is the worst week of overbidding. So the overbidding peaked early this year and it's dropped. And we're now having one of the least amount of overbidding in the past 52 weeks. Here now we're looking at the 3 counties individually. We got San Mateo County in the orange, Santa Clara in the blue, and the gray is Alameda County. This is inventory. You can see inventory went down in all the counties in Silicon Valley and bounced back up a little bit. It bounced back up the most in Alameda County. So you were here before the 4th of July, dropped all the way down and came back. But look at the drop in Santa Clara County versus the recovery. Look at the drop in San Mateo County versus the recovery. So the recovery really did not happen in Santa Clara County and in San Mateo County like it did in Alameda County. Here's the offers accepted. We expect the bounce back from the dip. This is the dip for the holiday. We expect the bounce back next week. There's no way to know what the numbers will be for next week because it hasn't happened, but that's what my expectation would be. Here's your marketing time. Because you have the dip in offers and the increase in inventory, the days unsold inventory has increased from last week to this week in all counties. But notice that San Mateo County used to be up here at 50 days, dropped down to something close to 40 days, and now bounced back to 45. So it's still 5 days faster this week than it was just 2 weeks ago. Santa Clara County is pretty close, might have a half a day difference. Alameda County is actually higher than it was 2 weeks ago. So not every county follows the same pattern, which is why I think it's important to look at not only county data, but micro market data. Here's your marketing time, the 75th percentile. Look at the increase in Santa Clara County. In 1 week, we went from what I'd call 26 days to 32. You gained 6 days in 1 week. That's huge. All of them are climbing. All 3 counties are climbing. They're all pretty close together from 32 to 37 days. So pretty close together. Here's the seller's ask price reductions. And they're taking a 1.5% on average. So all 3 counties are very, very close together. I would have to expand that to see which is the worst. It looks to me like orange, which would be San Mateo. If I was to call it, it was San Mateo, then the blue, and I think the gray is up here just above the 1.5% price reductions. Here's the frequency of price reductions. Santa Clara County has the least. Alameda County has the most, but all very close together from 21.5% to 24% of the sellers are doing a price reduction. So Alameda County is almost that 1 in 4 price reductions, and that's getting to be pretty high on the level of normal. Here's the magnitude of overbid coming down in all 3 counties. San Mateo County has the least overbidding. It looks like 3%. Santa Clara at 3.5%, and Alameda County, that has the longest marketing time and the most price reductions, has the most overbidding at almost 6%, 5.5% overbidding. I suspect what's happening is the market's slow enough that sellers are taking price reductions and they're overshooting where the market is, causing the buyers then to recognize, hey, this is a good value, and coming in and overbidding the reduced buy. For whatever reason, buyers tend to wait for sellers to reduce their price before they go in and make an offer. Here's the frequency of overbidding. Again, very close together, right at 60%. It looks like Santa Clara County actually has the least amount of overbidding at about 57.5% of the sellers getting more than their ask price. But again, very close to 6 out of 10 sellers, 3 out of 5 sellers getting more than their asking price overall. Here's the appreciation. Santa Clara County has the highest appreciation, and this is artificially high, and we'll talk about that in a little bit, but that's about 114%. San Mateo County and Alameda County are very close together, about 75% appreciation. Here's your median sold price. Santa Clara County is higher than San Mateo County currently by about 50,000. Alameda County is the most affordable. You can see that all three of them are at or close to their 2022 peak. Santa Clara County is the only one that's above their 2022 peak, and that's the median, and we'll get into market mix in a little bit. I think that's a fake reading. It's not a fake reading, it's a reading created by the market mix shift. Here's the same information on regular paper, and you can see that San Mateo County is right at 2 million, and Santa Clara is at 2.5 million. Alameda County is at 1.3 million for the median price. Here's the estimated payments using the high balance conforming loan for the national average. You could do better than that because you're going to be borrowing jumbo money if you're doing an 80% loan. Also, if you put more than 20% down, or if you have retirement money investments, that you can have a relationship bank interest rate pricing with your lender. We give you lower rates. Here's the micro market activity. You can see that Santa Clara County is in the blue or white, except for Cupertino and Saratoga Los Gatos, where they have less inventory than normal. Los Altos is basically right at normal, and so is Campbell. So you sort of have a part of the area that's at or below, and then the more affordable areas are above their normal level of inventory. Here's the offers accepted. The offers accepted are less across all areas. There's a few areas that are white in color, but you can see some of your best areas are offers accepted. Los Altos, Palo Alto is at 105%, so 5% above normal. And then the other one that's noteworthy is Cupertino, Sunnyvale at 94%. That's below normal, but it's still quite a bit above the 81% for the county as a whole. So those two areas are selling more than their share of the marketplace. Again, you can see offers accepted as blue in color overall, so below where you'd expect it to be. Here's days on unsold inventory. So here's where you're looking at just raw count. And, these are reasonable numbers. I mean, to sell your entire inventory in 19 days, to sell your inventory in 33, I mean, some of the highest numbers I'm seeing in Santa Clara County is 58. Come down to San Mateo County, you got 52 for the coast, and you got 126 for Atherton, but both of those are relatively small areas. So then you go to 47 days. You come down to Alameda County and you've got a little bit higher numbers, 94, 171, 167. So you can see why sellers in Alameda County are doing those price reductions, because they're long time on marketplace and then overbidding. But now what we're doing is we're comparing those numbers that, for the most part, especially if you ignore Alameda County, that we're favoring, we're still hot. This is where we normally are. So we're cooler across all areas except for two expensive areas in Santa Clara County, Saratoga Los Gatos and Cupertino and Sunnyvale. They're doing reasonably well, and they're actually lower. And Los Altos and Palo Alto is not colored, but it's still less than 100%. So they're selling more rapidly than they typically do, where the rest of Santa Clara County is taking longer. Here's your marketing time for 3 out of 4 sellers. So even though here, these numbers are reasonable, all pretty much under a month in Santa Clara County, except for Morgan Hill and South County at 52. Well, I guess we got 38 and 36. So around a month or less, except for South County. You go into San Mateo County, you got the coast at 2 months. Everybody else is at basically a month. And Alameda County is somewhere between about a month and a half. So fairly quick for 3 out of 4 sellers to sell. But if you compare it to where they normally are selling, look at these numbers. They're taking 2 to 3 times longer than they normally take to sell. That's trying to convey that Silicon Valley is normally a raging, red hot marketplace, and now we're just a reasonably hot marketplace. So we're way slower than we typically are based on days on market. So it's the same person using the same metric. We're comparing to where we normally are, and you're 2 to 2.5 to 3 times slower than you normally are. But you go back here, and these times are still reasonable. So that's the takeaway out of this whole presentation. The market is slower than it typically is, but it's still fast paced. Here's the ask price reductions. Fairly reasonable numbers, blue in color, but not hugely blue in color. 1%, 1.5% price reductions, 2% in Saratoga Los Gatos, 2% in Los Altos, 2% more or less in San Mateo County, 1.5% in Alameda County. But now compare that to normal. This is comparing price reductions to where they normally are for this time of the year, comparing the same week to the same week. The only area where they're less than normal is in Saratoga Los Gatos. Here's the frequency of price reductions. So to have pretty much less than 1 in 4 sellers doing a price reduction, 21% in Santa Clara County, 22% in San Mateo County, 24% in Alameda County, that's good. Less than 1 in 4 sellers are doing a price reduction compared to normal. 150%, 110%, 130%. The only one that's reasonable is Cupertino Sunnyvale at 100%. Come down to San Mateo County, 190%, 400%. Foster City, small area, of course. So again, this is conveying that even though the frequency of price reductions is fairly reasonable, it's much higher than it normally is compared to the same week year after year for the past 10 years. Here's buyers overbidding. So you have respectable overbidding. You're going Santa Clara County 3.6%, San Mateo 3.1%, Alameda County almost 6% at 5.7%. But compare that to normal overbidding, you're taking your 97%. And 97% overbidding may not sound like a lot, but at that point, that's 3% off. Buyers wait till the seller reduces their price and go in. So these are actually what I call a tight metric. So at 97, I'm solid blue. At 99.5 is where I start going blue. So very tight metric. Frequency of buyer overbidding. Look at these numbers. They're basically in the high 50s and in the low 60s, some 70%. So that's telling you a lot of buyers are overbidding. But now compare that to where the frequency of buyers overbidding. We're only selling only 70% of the buyers that normally overbid are overbidding. So it's a cool marketplace compared to normal, but it's still a hot marketplace. So I don't know how many more times I can stress that. So here's our appreciation since last 9 months of 2015 as our base year. You can see Santa Clara County has the most at 114%, but I'm going to point out something here that's noteworthy. Your expensive areas being Cupertino, Sunnyvale, Saratoga, Los Gatos, and Los Altos, Palo Alto, we're basically selling a disproportionately large percentage compared to the rest of the valley. In other words, I forgot what the exact numbers were, but these three were all close to 100% of their normal level of offers accepted, where the other areas that are more affordable were somewhere around 75%. So now the 3 expensive area regions, micromarkets, are making up a greater percentage. Even the cheapest 10 percentile in these areas is higher than the median price. So every transaction in these areas raises the median price. That's why the median price for Santa Clara County is 114%, when the single area that has the highest micromarket area is 102% in Milpitas. So normally you wouldn't expect to be able to have a overall number higher than each one of your components. But because these components down here, the expensive ones, are now making up a bigger percentage of the marketplace, that raises the county's median without raising property values. So a better way of doing what your property values are is to look at these micromarket areas and say it's probably somewhere around 90%. And that's because you got some 80s, you got some 67s, you got some 93s, you got 101, you got a 91, you got a 93. So the number is probably closer to something like 90, which puts it more in line with San Mateo at 84% and Alameda at 76%. So I'm not saying that Santa Clara County is not doing the best out of the 3 counties, but I am saying it's not doing the 113% when you compare the same property. Yes, it's the county median, but the county median's inflated because the expensive areas are now making up a larger percentage of the market share that they do. Maybe I'll actually calculate what the market share is and get back to you next week on that. Here is what I'm talking about. The cheapest for the countywide, the median price is $2,050,000. So if you come down to those expensive areas, even the cheapest homes in those 3 areas is above the median, raising the median every time a house sells in one of these expensive areas. Now, the other areas would actually tend to pull down the median because the median price is below the median for the county. So it's that shift from in typical distribution to favoring the expensive areas that caused the countywide number to go up. Anyway, on the prices, I sandwich it. I put in the cheapest 10 percentile of the home you'd expect, the median that most people follow, as well as the 90%. That gives you a sandwich of price ranges in each one of the 20 different micromarket areas. You also have Silicon Valley overall in the 3 counties. I put the dash marks over here so that you can hopefully see the counties more readily, and then the micromarkets areas under each county. Here's a summary of the slide. And again, the green is the year-over-year comparison. So you're comparing the same week to the same week in the previous 10 years. and doing a ratio. So clearly we're cooler than we normally are because the blue way outweighs the pink over here on the year-to-year comparison, but we're still reasonably balanced to a reasonably fast marketplace when you look at the overall. Yes, sellers are doing a little bit more price adjustments than they are, but their time on the market, their DUI, their overbidding is still very reasonable when you put it compare it to any normal benchmarks. And then you have the appreciation and the price range. So this is sort of a summary slide that tells you a lot of what's going on. And, if I was to allowed only one slide, I would take the chapter slide because with a magnifying glass, you could read every one of the slides. But this would be my one full size slides that I would use to try to figure out what's going on in a given area. It's got all the information. It just takes a while to go through and figure out what it all means. Here's the number of sales. I do want to point out that we sold 2,062. That is not close to a record low because we sold 2033 and 2057. But these numbers are all very close together. And that's the same case for the previous 3 weeks. 2171, 2168, you're only 3 away. These numbers here are not yet finalized. There's going to be escrows that fail to close. And until they close, I continue to adjust this number. So there's a very good chance that these last 3 weeks, in fact, I've already said that the 2 weeks ago will probably become the second worst year because I am expecting 6 more transactions to fail. Whether that happens or not, only time will tell. These are probably going to be in the same league where, well, actually this one probably isn't. A week ago isn't because it's already below the 2168, but it's not below the 2097. And I doubt we're going to lose 70 transactions. This 2062 will most likely fall below the 2057, and it may fall below the 2033. So basically, even though it may not be record low numbers, if you ignore 2023, which is the record worst year we had as far as volume of transactions, we're going to be close to the second worst year. Here's the summaries for each one of the counties: Santa Clara County, San Mateo, and Alameda County, and Silicon Valley overall. You can look at what numbers important to you. You can see that inventory increased in Alameda County, new listings, but it decreased in both San Mateo County and Santa Clara. Total available inventory went up across the board, up 7.7% in 1 week, 5.6 in Santa Clara, 3.5 in San Mateo. And again, here's where I'm showing you, I like the 75th percentile on here, but for those that want to use more standard metrics, you got the days on market median at 15, 13, 14, and 17. And you also have the average, 26, 24, 27, and 27. I prefer the 34. They're all measuring the same thing. The 75th percentile just gives you more swing. Price ranges, price reductions, and appreciation. We have been talking about the Silicon Valley real estate marketplace. We will talk about the Greater Bay Area and 5 regions. I'm Richard Calhoun, real estate broker here in Silicon Valley, working with single agency transactions representing either the buyer or the seller, but not both. Appreciate subscriptions and likes to the YouTube archives. And if you want to go to the channel, the YouTube channel, it's this blue URL up here. The shorter typing one is what I call the green root URL right here. That gets you the same location. If you add in the year to the green root URL, you get to the meeting presentation at 9 o'clock Saturday morning. If you add in the letter H for handout, the year, month, and date code, so it'd be H2025-0712 for 12, you would get the handout. It is up at the beginning of this presentation. That's my goal, to get it up about 15 minutes before the hour. I did accomplish that this week. And if you want any specific episode without going to the YouTube channel, you just type in the green root URL of the year, month, date of the Saturday presentation that you're looking for. Moving on to the Greater Bay Area, these are the 5 regions and the 13 counties that we'll be covering. Here's the inventory. You can see inventory has been basically climbing. It dipped in most of the region. The only region that really didn't dip was Santa Cruz and Monterey. And you can even see there was a slight dip even in that county. It had the least dip of anyone. Here's the offers accepted. You can see offers accepted are going down in 4 out of 5 regions. I would say they're flat in the Central Coast area. Here's your days unsold inventory. Improved going into the holiday, worse than coming out of the holiday, very typical. I would expect next week to be an improvement again. I expect it to be an improvement because I expect offers accepted to increase. Marketing time is basically increasing in all 5 regions. Note the huge increase in the cities. They went from something like 26 days to sell 3 out of 4 houses up to 54 days. And they did that in just a matter of a few weeks. It's clearly before the quarter break. So I would say they did that in about 5 weeks would be my guess. It's a tight horizontal date timeline, but it looks like about 5 weeks. Here's your ask price reductions going down in all the regions. Santa Cruz and Monterey, as well as the cities, did a little plateau this last week, but the trend in all 5 regions is down, which would be sellers taking larger price reductions. And this is the average. The frequency of price reductions is increasing in all regions. A noticeable dip in the Central Coast area, Santa Cruz and Monterey, flat in the North Bay, but I would say they're all still just increasing with some fluctuation, probably due to the July 4th holiday. Here's your overbidding, going down in all the regions, but clearly going up in Central Coast. So that's a clear exception. And I would even say the cities has been flat for about 3 weeks now. Here's overbidding, the magnitude, down in 4 out of 5 regions. The exception is the Santa Cruz, Monterey, Central Coast region, which is going up, and it's gone up for at least, it looks, well, maybe that's only 1 week, but it's gone up significantly enough that it's reversed its downward trajectory. Here's the long-term appreciation. The cities is by far the worst. Silicon Valley has the highest, but that is market mix. So the other one that I haven't looked at in detail is the Central Valley, is basically probably got the overall highest appreciation. And I think that's mostly a similar thing where mountain houses become a lot of resales in that area, and that's more expensive than the Central Valley in general, which would pull up their median price, even though property values aren't improving. So it's sort of the same type of thing. Here's your prices. Prices are basically about the level they were in 2024, as well as where they were in 2022. You can see I drew the lines back. The one exception is prices in the cities was significantly higher in 2022 than it is now. But there are very similar patterns, so except for that one exception. Here's estimated payments, assuming an 80% loan at the federal high balance conforming loan limits. And here is the metrics for each of the 13 counties in the 5 regions. I also put in the Bay Area just because the media talks about it. You have the now, which is the raw count. You have the percent change from 1 week ago and the percent change from 5 weeks ago for each one of your different metrics. And now we're back to the chapters. You can jump to the chapter you find most interesting. The timestamps in the YouTube description below. Again, I'm Richard Calhoun, real estate broker with Creekside Realty. I don't see any unmuted mics. So have a great week. See everybody next week. Take care. Bye for now.